We'd like to wish everybody a Merry Christmas before we get started, and just hope that you'll find the information that we have for you today to be useful. What we're going to do is we're going to start out with some information on capital assets. I know that we went through this in July at our July monthly meeting, and we had like an Excel spreadsheet that we went through for the capital asset ledger and the gateway information. Today we're going to go through it on slides, and we'll go through it pretty fast because we've done it once already. This is just kind of a refresher, but we thought the slides might be helpful for you to have to go back to have as a resource. And then Todd's going to come in with some information regarding some SRF loans and some other information that you'll find very valuable after that. And then the last hour, we'll devote that to questions. So with that, I'm going to turn my video off for now because I'm having some internet issues today, and hopefully I won't be freezing up on you as I'm talking. If I do, then Todd will stop me and we'll find another way to get through it. Okay, well, let's go ahead and get started with the capital assets. Just wanted to remind you that the capital asset schedule as it looked in 2020, this is what you were familiar with before, with the column all the way to the left with the various categories of assets. Then you had to put in your beginning balance, your additions and reductions, and then arrive at your ending balance. That's what it previously looked like, but it's changing this year. And this is what we expect it to look like on the AFR for 2021. So you'll see now there's not just one category for government activities. There's actually 3 categories for governmental activities. And that's split out. The top is not non-depreciable assets, which is going to be land, construction in progress, and then other non-depreciable assets, which would be like art or artifacts of some kind. Then the second category for government activities is going to be depreciable assets, to include infrastructure, buildings, improvements other than buildings, machinery, equipment, and vehicles, and then books and other. And then in the bottom category is going to be the accumulated depreciation that you calculate for those assets that are depreciated. And we'll go through an example of how you will come up with that number. Okay, so let's just kind of do a refresher back to the beginning. What a capital asset is. It is something that is owned by your city or town, and it has a useful life extending beyond 1 year. And it meets the threshold that's set by your council in a capitalization policy. We'll talk about that soon. There are major categories for capital assets, and that would be land, infrastructure, buildings, improvements other than buildings, machinery, vehicles, and equipment, and then books and other. Now, what is depreciation? Depreciation is just an allocation of the cost of an asset across the life of that asset for those assets that have a determinable life, a determinable useful life. So a useful life then is an estimate of how long a piece of property or an asset will be expected to be usable. You can base that information on your experience, or you can base it on a table or some reputable internet source of information. But it should be included in your policy. For example, on the internet, you might find that machinery and equipment has a 5 to 7 year useful life. You might find something that says that. You might know based on your own experience, maybe a particular piece of machinery lasts longer than that, or maybe it lasts less than that. You can use the most accurate estimated useful life for your unit. This information for depreciation is new this year, and it has been determined that the information is needed by our financial statement users. Examples of those would be bond rating companies. And so the state examiner has prescribed that depreciation will be calculated and included in the notes to the financial statements under his authority in Indiana Code 511. All right, now I mentioned a capitalization threshold a minute ago, And that is just your board policy that states the threshold at which an item is considered a capital asset for financial reporting purposes. Only those items that exceed the threshold are placed on the capital asset ledger. For example, if you have a piece of equipment, let's say your threshold is $5,000, you have a piece of equipment that costs $8,000, you're going to include that on your capital asset ledger. If you have a piece of equipment that costs $3,000, you're not going to put that on your capital asset ledger, but you are going to still keep track of it as part of your inventory system because we still have an obligation to keep track of all the assets owned by your city or town. It's just that only certain ones are considered significant for financial reporting purposes, and those are the ones that are on the capital asset ledger and will be depreciated. For the estimated useful life, we kind of talked about that already. That's going to be your board policy establishing a number of years over which the cost of an asset will be allocated. And then your method is how you do that allocation of the cost. And most oftentimes, governmental units are going to use straight line depreciation. In your capital asset ledger, you're going to record the purchases and disposals of capital assets. These are going to be recorded at historical cost, which is generally the cost of the item when it was purchased. There are some items that you might have on your ledger that you really don't know what that historical cost was, and you can estimate that. You can do that. One of the easiest ways is using the Consumer Price Index tables that will be in the December 2021 bulletin. They were also in a 2020 bulletin as well. Or you can just do a reasonable estimate based on maybe there's some historical records or maybe there's some trade journals or something you can look in to make that estimate. It's really just important to document how you made that estimate and that the estimate is reasonable. And then of course your ledger is going to have assets by type or category. So you'll see on the next slide, we have an excerpt from the September 2019 Cities and Town Bulletin where we attached the newest version of the capital asset ledger. And you can see the various categories it has there that we've talked about, describing the asset and when you purchased it, where it's located, the original cost, and so forth. Okay, so about depreciation, which is new this year. Most oftentimes, governmental units are going to use straight line depreciation and apply that to individual assets. And the formula for that, annual depreciation, is just your historical cost divided by the estimated useful life of that asset. When you're figuring accumulated depreciation, that is going to be your annual depreciation times the years in service for that asset. You don't want to calculate annual depreciation once the asset is fully depreciated. You don't keep adding over and over. It'll just be depreciated up until the historical cost amount is reached. When you dispose of the asset, then you will remove the accumulated depreciation from your ledger as well. And then you can adopt a policy to recognize a full year of depreciation in the year you acquire that asset, even if the asset is acquired, let's say in November. If it's in your policy to go ahead and recognize a full years of depreciation, you can do that. It just needs to be in your policy that way. There are some units that will take like a half a year depreciation in that first year and then a half a year in the year it's disposed of. You can do that too. It just seems like it might be easier if you did it in the year of acquisition for a full year. Okay, so let's talk about non-depreciable assets and what those are. The first category is land, and then there will be works of art, if you have any of those, or historical treasures, artifacts, and those types of things. And then construction in progress is also something that is not depreciated. So talking about land then specifically, that is going to be included on the capital asset ledger at historical cost. And historical cost is the same thing as acquisition cost. I know that a lot of people say, well, that doesn't have anything to do at all with, our land is worth much more than that now. Of course, the current market value is going to be different, but we're looking for historical cost on your financial records. If you need to estimate historical cost, you can use the fair market value currently multiplied by the consumer price index factor that's applicable, and I'll show you how to do that. If you don't know the fair market value information, then you might need to talk to your county assessor. They might have that. There might be some historical records that have approximate land values. You might be able to get the information from a realtor, but there are different places you can go to find that historical cost number. Land is not depreciated. It is shown in the category of non-depreciable assets on the annual financial report. So if we just look here on the capital asset ledger that I have, my date of purchase of property was January of 1964. I have my land, I have its location, and my original cost was $100,000 for land. So I've shown that in my original cost and in my land column, and then over there in total fixed assets. And that information is just to record the historical cost of land in my ledger. The second box is what it would look like on the annual financial report in the non-depreciable assets section. You can see I have land there with my beginning balance of $100,000, and then that carries over to my ending balance as of December 31st of 2021. Now let's say in 2021, I wanted to buy a parcel of land that was next to my town hall, and the cost of that was $50,000. I would go ahead and record that as my date of purchase for 2021 and the address of that parcel. And then I'm just going to add $50,000 there to my original cost. I'm going to show it in the land column and carry that over to fixed assets. So on the annual financial report then, again, I have land that I had before in my beginning balance, but I just show that $50,000 as an addition for 2021, and then that carries all the way over to my ending balance. Now, when talking about works of art and historical treasures, some of you may have those types of things. They're included on your capital asset ledger at historical cost under books and other. Again, historical cost is going to be the same thing as acquisition cost, but some of you may have had these things donated to your city or town, and those are going to be shown as of the fair market value on the date that it was acquired. Some people have asked if they can show this on their capital asset ledger, these items in a separate column, because they're non-depreciable and some of their other assets might be depreciable. That's fine if you want to show them on a separate column in your capital asset ledger, but when you get to the annual financial report, you'll need to put them back into books and other. You can estimate your historical cost on these, possibly estimate it based on auction sites or publications related to that type of asset. Again, donated items are shown at the fair market value at the time they were donated. Works of art and historical treasures are not depreciated. They're shown in the category of non-depreciable assets on the annual financial report. And then some examples there might be paintings or sculptures or artifacts. Construction in progress is another non-depreciable group. You'll include those again on your capital asset ledger at historical cost, which is the same thing as acquisition cost. It is not depreciated. And upon project completion, the costs that you've accumulated in construction in progress are moved over to the appropriate category when the asset is placed into service. So if you're in the middle of a building project, you're going to accumulate those costs in construction in progress until the building is completed, and then you're going to move those out of construction in progress over to buildings. So let's take a look at an example of that. I have here that in 2020, we had a new town hall annex, and the cost of that was $500,000. So I'm going to show that my original cost of $500,000 was accumulated in 2020. So I'm going to show that in construction in progress, and then that's going to go on over to my total fixed assets. Okay, and then you can see that there on the annual financial report for non-depreciable assets. At the end of 2020, I have construction in progress of $500,000 accumulated. Okay, now if in 2021, then I'm going to go ahead and finish that annex because it wasn't finished yet in 2020. So if you look on that second line there, you'll notice that my original cost now is $750,000. I had $500,000 accumulated already. In 2021, we incurred $250,000 more. So my total cost for that new town hall annex is going to be $750,000. Now, if you look at that top line, where I had new town hall annex CIP, construction in progress, if you go over to the construction in progress column, you can see where I've removed the $500,000 that we accumulated in 2020, and that's now included in the total amount for 2021, and it's moved over to buildings. And I have an estimated useful life on this building of 75 years. Again, the numbers that I use in these examples are really just for ease of division or multiplication. So, you know, I don't know that that's a reasonable estimated useful life, but that's what I have here because it's it's a number that's easy to talk about. Okay. On the next page, I show you here how it should work for 2021. So we had our accumulated costs of $500,000, which are as of January 1 of 21. For construction in progress, we took that out because the project was completed in 21. So at the end of 2021, my construction in progress is 0. And then down under depreciable assets, you can see on buildings, I already had a building worth $400,000. I add in our new annex of $750,000, and then I have an ending balance of $1,150,000 for my buildings. Okay, so we'll go ahead and talk about depreciable assets now. I don't know why infrastructure is not listed there, but it should be infrastructure, buildings, improvements other than buildings, machinery, equipment, vehicles, books, and other. So I don't, for some reason, I don't have a slide on infrastructure, but it's going to follow the same logic as all of these other assets. You're going to include it on the capital asset ledger at historical cost. Again, same as acquisition cost. You can estimate that historical cost by using a fair market value or a replacement value times the consumer price index. For buildings, county assessor may have that information, or your insurance company might have a replacement value. And then again, you multiply it by that consumer price index factor. Buildings are included in the annual financial report under depreciable assets, and your best practice would be straight line depreciation. So on this asset, we have our town hall, which was purchased back in 1964 for $400,000 with an estimated useful life of 80 years, and we just carry that on over into the proper categories. And on the annual financial report, again, buildings, my beginning balance is $400,000, and my ending balance was $400,000. Now to depreciate that building, again, the formula for depreciation for annual depreciation is historical cost divided by estimated useful life. So my annual depreciation every year for that building until it's fully depreciated is $400,000 divided by 80 years. So it's $5,000 every year of depreciation for that building. Now remember, for the annual financial report for January 1 of 2021, we're going to start as if you've depreciated that building all along. So your accumulated depreciation for that building is going to be the years in service, which for this building, it's been 57 years. I'm going to multiply that by 5,000, which is my annual depreciation amount. And I'm going to arrive at my accumulated depreciation of $285,000. So that's how you're going to do that. And then you're just going to show it. Here's two categories, both involving buildings. The top one is matches your capital asset ledger, right? So you have the $400,000 building. Then the second category is the accumulated depreciation. So for your buildings, you're going to have a beginning balance of $285,000 because that's as if you had been depreciating it all along. And then for 2021, you'll add another $5,000 in depreciation for that building. Okay, for improvements other than buildings, same logic follows. It's at historical cost. You can estimate that historical cost. Examples of these would be your parking lots, driveways, walkways, fencings, fountains, those types of things would be improvements other than buildings, and you would use straight line depreciation. So on my example here, we have fence and landscaping that we put in back in 2000. And the cost of that was $5,000 at the time, and we estimated that it would be good for 10 years. Of course, now it's been 20. My improvements other than buildings shows $5,000, and my total fixed assets shows $5,000. And then on the annual financial report, beginning balance of $5,000, and then so far I've had no changes to that, so the $5,000 carries over to the ending balance as of December 31. For that fence and landscaping, we again are going to calculate annual depreciation, which is historical cost divided by the estimated useful life. So for this fence, I have $5,000, and historical cost divided by 10 years is $500 a year. My accumulated depreciation is the years in service times the annual depreciation. So that's $500 times 10 years, which is $5,000 as of January 1. Now you need to note that this asset was fully depreciated after 10 years, but it's still been a good fence up until 2020. So you don't need to continue to depreciate it after it's reached its estimated useful life. You do need to keep the asset on the capital asset ledger and in the accumulated depreciation balance until you dispose of that asset. Okay, so on the annual financial report, improvements other than buildings, you can see that matches my capital asset ledger there at the top of $5,000. And then I've added accumulated depreciation. Again, my beginning balance is as if I had depreciated this fence all along. So I have a beginning balance of $5,000. I'm not going to add anything to it because it's already fully depreciated. Okay, so let's say this in 2021, I want to redo the fence and the landscaping. So you can see that I have recorded the removal of the fence and landscaping in June, and I've subtracted that total historical cost amount from improvements other than buildings and from my total fixed assets. And then I will also remove the amount of depreciation from accumulated depreciation to $5,000 because that had been fully depreciated. Now I'm going to also, I need a fence, so I'm going to record the purchase of a new fence and some landscaping in 2021, and that's going to cost me $20,000. And it's just like anything else, you're going to take it over to the proper column for the historical cost amount, and then your total fixed assets. Now, like I said earlier, for depreciation purposes, you may want to add a full year of depreciation for the new asset in the year of purchase, just because it makes it a little easier. So you can show the annual depreciation for the new fence as an addition to accumulated depreciation. I'm sorry, that should say in 2021, which is the cost of $20,000 divided by the estimated useful life of 10 years for a total of $2,000. So we can look at our transactions here from the top category, again, matches our capital asset ledger. So you can see I started out with the $5,000 fence. I added the $20,000 fence, and I took away the old fence of $5,000 to arrive at my ending balance. And then at the bottom, on accumulated depreciation, I started out with a fully depreciated fence of $5,000. This year I added the $20,000 fence, and I took 1 year's worth of 1 year's worth of depreciation since I bought it this year. And then I reduced the fence that I got rid of. I took that entire amount of accumulated depreciation out to arrive at an ending balance. Okay, machinery, equipment, and vehicles. Again, the same thing. It's included on the capital asset ledger at historical cost. You can estimate that historical cost. Machinery, equipment, and vehicles are included on the annual financial report under depreciable assets. And examples of those would be vehicles, tractors, snowplows. And again, your best practice is straight line depreciation. So if I have a truck that I'm going to record on the capital asset ledger, I'm going to record it like I would any other asset with the date of purchase and a description of it as a Ford 150 pickup in my case, and where it's primarily located on Main Street. My cost was $50,000 in 2020. We have determined for our town that the Ford pickup is going to last about 10 years. And then I'm going to show the pickup and machinery, equipment, and vehicles, and total fixed assets. The depreciation calculations is going to be the same, with your annual depreciation being your historical cost divided by the estimated useful life. So in my case, that's going to be $5,000 each year for this pickup truck. And my accumulated depreciation is going to be the years in service times the annual depreciation. So it's been in service for 1 year as of January 1 of 2021. So I'm going to take 5,000 times 1 year for my depreciation, because I've adopted that policy to show a full years of depreciation in the year of acquisition. So if you look on the gateway information, that top line again matches your capital asset ledger. I have my truck in there for $50,000. And then down at the bottom on accumulated depreciation, as of January 1 of 21, I already had 5,000. Remember, this year in 2021, I also need to add another year's worth of depreciation. So it'll be the beginning balance will be 5. I'll add 5 more for a total of $10,000. Now let's say in 2021, I need a tractor. So I'm going to do that, and the tractor cost me $8,000. At our place, we think that 10 years is a good estimated useful life for that. And I'm going to show it again like I did the truck and machinery, equipment, and vehicles, and over in total fixed assets. My annual depreciation is going to be the same. It's historical cost divided by the estimated useful life, which is going to be $800 a year. And again, I'm adopting that policy that I show a full year's depreciation in the date of acquisition, or in the year of acquisition. So that type line again is going to match my capital asset ledger. The machinery and equipment, I have my truck in there already for $50,000. I'm adding this year a tractor. So now I have an ending balance of $58,000. And then for the accumulated depreciation section, I have my $5,000 for my truck because I had that already. That was my beginning balance. And then in 2021, I added $5,000 for my truck again and $800 for my tractor. So I had to add those two together for the additions. So on the capital asset schedule, information for that, a couple of things to remember that our field examiners are going to be looking for. First, you want to make sure that the annual financial report beginning balance agrees to your capital asset ledger. And then you're going to want to post additions and reductions on your annual financial report from your capital asset ledger for 2021. Those should match. And then you'll want to confirm your ending balances on the annual financial report agree to your capital asset ledger. You do need to calculate accumulated depreciation as of, should say, January 1 of 2021, right? That is as if you have depreciated your assets all along. And then you'll calculate your depreciation for 2021. So I'm sorry for that typo. That should be calculated accumulated depreciation as of January 1, 2021. Okay. I'm going to go ahead and turn it back to Todd now. I'm sure there's a lot of questions that came in on depreciation, and we can address those in the next hour, but I want to make sure Todd gets his time for some other topics, and then I'll come back and talk about the American Rescue Plan.
Good morning, everyone, and happy holidays. Here's a slide that shows some of the items that I'm going to cover. SRF accounting, a lot of new entities and cities and towns are getting into the SRF loans, and so they may not be familiar with how to account for those. We'll also talk a little bit about CARES. I know CARES, was last year's, hot topic, and this year it's American Rescue Plan, but there are some still lingering things with CARES that we want to touch on. Cyber incident reporting, that's a new thing now. If you're having that, you need to report those types of things, and we hear quite often of some city or town that's had some kind of incident, and we want to refresh everybody's memory on reporting those. We're going to talk about an all-inclusive bank reconcilement. That's something that you may or may not be doing right now, but if you can do it, it's a great benefit to our field examiners when they're doing the audit. And then finally, we'll touch on the email that we sent out a couple of days ago on reporting misappropriation of public funds. So we're using the state revolving fund information just as a reminder, because we've seen that pop up recently and not being accounted for in the way that it should be. If you have an SRF where the Bank of New York Mellon is the trustee, BNYM holds that money in an account that's in your name, and that money and the related financial activity in that account needs to be included in a fund, or if you have more than one account, funds on your ledger and books, and then it subsequently gets reported on your annual financial report. So even though those dollars don't physically flow through your control, they're still considered public funds over which you still have a fiduciary responsibility. And then noted on the slide are a couple of criteria that would require this. Excuse me. One's from the Cities and Towns Manual. It mentions all financial transactions have to be recorded in the records of the unit. And the other one is from the Regulatory Manual, which says basically the same thing. All financial information of the entity shall be included on the financial statement, even if the activity has not been included on the records. But you do need to include those SRF funds on your ledgers. We're seeing that some people aren't doing that, so we wanted to cover that today. If you've got any questions, obviously you can put it in the Q&A, and we'll try to address it later. I think the easiest way to do it, if you're wondering, oh, how in the world do I know what to post, or where do I get that information, you should be getting or at least have access to a monthly bank statement for those accounts from BNY Mellon. And what you can do is just go there, or from that statement, post that activity that's on there for a month. There's really no other way you're going to know that. I don't think you'll get that type of information during a month. So the best way that we think you can do that is just take the deposits into the account and post them as receipts to that fund on your ledger. Show the disbursements out of that account the checks that BNY Mellon are sending to the contractors that are doing the work or whatever. Show that as a disbursement on your ledger. And then your ledger ending balance should be what the ending balance on the bank statement is. Related to CARES, we've had some questions come in about the cash balance in your CARES fund. We have a link on the screen to the directive from last year, 2020-3, in which we talked about how to account for the CARES fund and some options related to that. That money, if you remember, ended up coming from IFA, and it was a reimbursement of public health and safety costs. And part of the issue is that the whole reimbursement part. The directive talks about the cash balance at the end of last year being zero. That you would receive that money in, you would either have reversed an expense from another fund, and then when you receive the money, that would zero that fund out, that CARES fund out. That was under option 1 in the directive. Option number 2 was to take the money, put it directly in your CARES fund, and then council could authorize a transfer from the CARES fund to the general fund, and then they could appropriate it as they wished. What's happened to some communities is the reimbursement came so late in December of last year that there wasn't time to do the transfer or to reverse the expense, or a lot of people got their money early in 2021, and that kind of tied their hands, because since we've moved to a new year, there was no expense to reverse since we closed out 1 year and started in 2021. So you're pretty much stuck with putting the money in your CARES fund, and then for council action, transferring it to your general fund for their appropriation. So we wanted to touch on that because we're seeing some people that weren't aware of that fact or haven't done it yet, and they've asked, I still have money in my CARES fund. What am I supposed to do with it? So we've referred you back to the directive, and option number 2 is what you'll want to do. So if you still have a balance in that fund as of today, we'd recommend transferring that to your general fund to get that CARES fund to a zero balance. And then to spend it next year, because we're so late in this year, it's going to need an appropriation to spend it. So you probably need to go through the additional appropriation process, and DLGF can always help you with any questions related to how that works. You might remember that Indiana lawmakers recently passed legislation that will increase the amount of information sharing regarding cyber attacks and other threats against across the state agencies and local government. So the new law required public sector entities to report incidents such as ransomware, software vulnerability, exploitations, denial of service attacks, and even more. So what you see on the screen is the link for reporting these incidents. It takes you to the IoT website, and there's a picture there of what it looks like. You have, let's see, I have a slide, nope. I wanted to point out too, you have 48 hours from the time the incident is discovered to report that. So that's important to remember, that all types of governments, counties, cities and towns, townships, schools, fire protection districts, they're all required to report these types of incidents at the IoT website. So what are cybersecurity incidents? What are these types of things that you might have to report? A malicious or suspicious occurrence that consists of one or more of the categories of attacked vectors is what IoT calls them, that jeopardizes or may potentially jeopardize the confidentiality, integrity, or availability of an information system, an operational system, or the information that such systems processes, stores, or transmits. It jeopardizes or may potentially jeopardize the health and safety of the public, or it violates security policies, security procedures, or acceptable use policies. So some of the specific types that need to be reported. The first one's ransomware. That's a malicious software designed to block access to a computer system until you pay a ransom or a sum of money. We've seen that happen several times. I haven't heard of any reports recently of ransomware, but that is still out there where they can get something into your system that prevents you from access to it, and they'll only unlock it unless you pay a certain amount to them. But the ransomware needs to be reported. This may be one that's more common. It's business email compromise. Scams targeting organizations, government, and other who conduct wire transfers or electronic payments would fall under this category. The scheme leverages email accounts, either spoofed or compromised, of executives or high-level employees involved in wire transfer payments to do a fraudulent transfer. So what we've seen sometimes there is you get an email that seems to be from the mayor or a council member, and it says, hey, we need to make this payment right away. We can't wait, it's late. Go ahead and wire this money to a certain place. And we've seen where people have done that. They've wired that money only to learn that the email that they got wasn't really from the mayor or a council member. It was just a fraudulent email to try to get some money. So you need to be aware of those things. If you have that happen, that needs to be reported to IoT. The next one is vulnerability exploitation. And those are weaknesses in a system component, including the operation system, software, or application, which are leveraged to force the component to act in ways that it's not intended, enabling unauthorized activities. Zero-day exploitation is an unknown exploit that exposes a vulnerability in software or hardware. Zero-day exploits are leveraged by attackers before the vulnerability can be patched or fixed by the creator of the product. Distributed denial of service, the intentional paralyzing of a computer network by flooding it with data sent simultaneously from many individual computers. And because most of you have a website, this might be something that you see as an attack on a website that changes the visual appearance of a website or web page. So even if someone hacks in and they change the way your website looks, that's considered a cyber incident that you would report. I failed to mention under business email compromise, we still see a lot of people that get an email that seems like it's from an employee, and they want to change their direct deposit information, and they might say, here's my new bank account information, I want my next paycheck to go there. And then that happens sometimes without any kind of verification process, and then the employee calls you the day after the payday and says, hey, where's my check? And then that's when you realize you've been scammed. So again, internal controls are a huge factor in some of these things. Some of them are really beyond your control, but the business email compromise is really one where controls can take place. If you've got some controls for verification, if you get an email from the mayor or you get an email from an employee and they want you to do certain things, you should have procedures in place to verify that information. Call the mayor, go to the mayor's office, or contact the employee, have them come in to sign something authorizing that transfer. Just don't take the email on its face value as being accurate and something that needs to be done right away, or you could find yourself or your employees, out some money. So in reporting these incidents, you'll want to go to the website, to that link that I showed you, and if you scroll down, there is a section as you see on your screen where you can report it. It's a box and it has a slider. So if you scroll down within that box, slide down, there is a place where you start entering information. They'll want to know your city or town, the location, so that could be the clerk treasurer's office, it could be maybe a police department or somebody else that's in a different building. When they ask for location, they're going to want to know the date and the time information. a description of what happened. So try to describe that incident as best as you can, including the details of the impact that it's going to have or has had on your organization. And then there's a button at the bottom that you can click on submit. So keep that in mind. These cyber incidents need to be reported. There was also a provision in the legislation that someone be designated as a contact, and that's on their website too. I believe it's right above where you report an incident is where you can sign someone up to be your contact. So if you haven't designated a contact with IoT, the Indiana Office of Technology yet, you need to do that, and you can do that at this webpage as well. Now we're going to talk about that all-inclusive bank reconcilement that I mentioned earlier. Again, this is a tool that we use in doing our audits. It's something that our field examiners will do when they show up if you haven't done it yet. And if you have performed this and can hand it to them, that's going to save them some time. They don't have to gather all the information to do it themselves. We trained on bank reconcilements and all-inclusive bank reconcilements in the past, so I'm not going to go very much in depth on it. If you don't remember it or you want part of it, you can see that training most recently. It was in August of last year. We did some training for some new clerk treasurers who either had been elected at the first of the year or most of them had been appointed to fill a vacancy, and they hadn't really had any new officer training. So we talked about it then. There is a video recording of it as well as the PowerPoint, so you can go to our website. I've got a slide of it there, or a picture of it on the slide where you can look under presentation of materials. The topic is newly elected or appointed fiscal officers from August of 2020, and then you can click on the link that says Bank Reconcilement, or you can watch the video presentation on it as well. If that sounds familiar to you, I just stuck a picture of the first slide of what that looks like on there in case maybe you already have that in your materials and you want to go back and look at it instead of going to the website. Well, let's talk about the bank reconcilement, the all-inclusive one itself. It is a combining or a summarizing of your reconcilements into one document in one place. So if you have a computerized system like Keystone, it likely doesn't do this for you. It's something that you could do on a spreadsheet. Again, if it's something that can be handed to our field examiners, that just helps them because this is something that they will do. And it wouldn't necessarily be something you have to do each month, but definitely at the end of the year. So in looking at this example for the town of Toddsville as of December 2021, let's say you had 3 bank accounts. You had a general bank account, which had all of your money from your town, city or town funds in it. A water account, checking account that had all of your funds for your water utility, and then a wastewater account that had all your funds for your sewage utility in it. And so you can see I've summarized those here, the beginning balance or the ending balances from the bank statement. So those top 3 lines, the $74,832, the $18,500, and the $11,000, those represent the 12/31 bank statement balance for those 3 accounts. If you have 7 or 8 or 10, I know some of you have a lot of bank accounts. Probably the first time you'll do this, you'll see why it'll save some time on the audit if it's done before we get there, because it does take some time. The more bank accounts you have for our field examiners to put this together. So again, if you have it for them, that'll greatly help. But it's just a summarization of each bank account, the bank statement balance, and then you want to add in deposits in transit because all of those accounts can have deposits in transit. In this example, general and water had deposits in transit and wastewater didn't. Then you're going to subtract out your outstanding checks. All of those accounts could have outstanding checks, and in this example, all 3 did. And then you might have those miscellaneous type items that you might either have to add or subtract. Each of those accounts could have NSF checks in them that you have to account for. They might have encoding errors. So in this example, the general fund had an encoding error of $9.90, and wastewater account had an encoding error of $0.10. So once you take all of those into consideration, you're going to come down to a subtotal of all of those funds, and in this case, it's $98,555.92. You then just show your ledger balance of all of your funds as of that same, so your year end. In this case, it's the same amount, and it shows a zero difference. Now, I put together some of the fund balances. I talked about the fund balances of all of your funds. Keystone will usually just do that for your reconcilement for the funds that are associated to that bank account, and that's where you would end up with multiple reconcilements within a system. Here, the general fund had a $27,000 balance. MVH had 17.9, and so forth, down to the total at the bottom of 98,555.92, and you can see how that correlates to where we put that amount on the all-inclusive bank reconcilement. So again, this isn't something that's required, but we hear from our field staff all the time how helpful it would be if they had that information when they walked in the door. You don't have to do it every month, but I would at least suggest doing it at the end of the year. If we have to come in and put all of that together, it can take, depending on how many accounts you have, it can take several hours to maybe half a day, maybe a whole day. And that's all time that we have to bill to you. So if you can hand it to us and we just have to confirm or verify or audit the information that's on that reconcilement, it's a big help, big help. And then the last thing I wanted to talk about before I turn it back over to Susan has to do with mass email we sent out on Monday, and it's just a friendly reminder of your responsibilities to report theft. I think a couple of people got the email and thought it was directed at their unit, and that was probably my fault in how I worded the information, and it wasn't directed at anyone. It's just, this is something that's come up recently. We've had a couple of instances where there had been theft that had not been reported to the Board of Accounts. So we want to make sure everybody understands what their responsibilities are. Indiana Code 511-127L requires a public officer who has actual knowledge or reasonable cause to believe that there's been a misappropriation of public funds or assets to immediately send a written notice to the State Board of Accounts and the prosecuting attorney. Sometimes they just contact us and not the attorney, but the statute does require a written notice to each of us, the Board of Accounts or the attorney. So that written notice can be a letter or it can be an email. If you call in, we're probably going to ask you maybe to send us an email so that's in writing, but just wanted you to know of that requirement. And there's no dollar threshold for this. So we talk about reporting other types of losses or variances over your materiality threshold that you've established. But for this kind of incident, there is no threshold. There's no minimum amount. So any amounts that have been stolen or suspected, you're supposed to report that to the State Board of Accounts. We also wanted to remind, that if this happens in your city or town and it doesn't get reported to us, it can result, and it probably almost always will result in an audit report comment. And it may also result in additional audit costs if we have to do, extra work because we didn't know about it beforehand. And be aware too that the reporting misappropriation to a law enforcement agency doesn't fulfill that requirement. So if you contact your police department or the county sheriff and say, hey, we've had a theft, that's not really provided for in the statute. It's a good idea, we would recommend it, but you still have to notify the State Board of Accounts and the prosecuting attorney in your county. And then if you've got, after you report it to us, we forward that information to our Special Investigations Division, and they may or may not be in contact with you. It just depends on the situation and the circumstances. But if they do reach out, our Director of Special Investigations, his name is Mark Mahan. He's been at some of our training in the past, so you may remember that name or speaking with him or hearing from him. And if you need more information on reporting theft, the last bulletin article that we had was in 2018. In March, it covers it. There is also a state examiner directive that was 2015-6, and that was the first time it came out about what your responsibilities were under that. So you can always refer back to that state examiner directive or the Cities and Towns Bulletin. So with that, I will turn it back over to Susan, and she can wrap things up.
You know, we can't hardly get through one training session this year without having to speak about the American Rescue Plan, and today is no different. I want to just hone in a little bit for a few minutes on premium pay. The reason I want to talk about it today is the state examiner has issued a directive since we spoke last. So I want to make sure everybody knows about that directive. It's available on our website, and that you kind of have an idea of what's in it. The reason this directive has come about is because there was a lot of confusion out there on bonuses and how those should be calculated, the difference between a bonus versus a lump sum payment for hours worked and a premium pay rate applied to those hours worked. So the state examiner wanted to make sure everybody was clear about what the requirements of the Act, the ARPA Act is, and what would be expected during an audit. So we'll just go through some of those key points. Remember that funds can be used for costs incurred to respond to workers performing essential work during the COVID-19 public health emergency by providing premium pay to eligible workers that are performing essential work. And the reason those main words up there are underlined is that those are specifically defined in the Act or in the interim final rule. So you want to be familiar with what those definitions are, and each one of those definitions is repeated in the state examiner directive, so you don't have to go hunt for them at all. One of the issues that we have is the American Rescue Plan Act, the frequently asked questions, the interim final rule. None of that mentions anything related to a bonus for employees. So part of the purpose of the director is to focus more on the fact that there should be an hourly rate, a premium pay rate, whatever that's decided, multiplied by hours worked for eligible workers doing essential work. And that essential work would be a position that has regular in-person interaction or the regular handling of items. It's not a position that would be work from a residence or teleworking like that. So that was an important distinction to make. There's also been a lot of questions about elected officials and you know, how that would work, because we have our own Indiana statutes that say that your elected official's compensation can't be increased in the year for which it's fixed, nor can it be reduced from the previous year. So if it is determined by your city or town that elected officials should get premium pay, then that would have to be adopted by the end of 2021 to be paid in 2022. Because once we hit 2022, your compensation is fixed, so it wouldn't be able to be changed after that point to allow for premium pay. So, and you can read all of that in the directive. I just wanted you to know it was there. Another thing that's in the directive are the audit expectations. We tried to outline what we're going to be looking for in an audit so you would be aware of it. So I just want to go through those things so that you can be thinking about it. The amount of premium pay provided to an employee has to be supported by an hourly rate for hours worked, and you need to keep those calculations for audit. Now, that's not to say that you can't make it in a lump sum for hours that have been previously worked. Remember, premium pay can be applied retrospectively to the beginning of the public health emergency. But you do have to have an hourly calculation, an hourly rate for premium pay times hours worked. Okay, documentation does need to be available for audit showing that premium pay was for hours worked with regular in-person interaction or physical handling of items rather than telework from residents. The U.S. Treasury's made it clear that this is for in-person work, not telework. Documentation has to be available for audit to show the amount of premium pay provided to an employee did not exceed $13 per hour or a maximum of $25,000 per worker. Those are maximum limits that have been set by the U.S. Treasury. The U.S. Treasury has also made it clear that this is geared toward lower income workers. So if the amount of premium pay exceeds 150% of the state or county average annual wage, the written justification for that payment does need to be maintained for audit. Premium pay provided to employees does need to comply with the Indiana statutes and be included in the salary ordinance or an amended salary ordinance. Premium pay provided to officials has to be included in the budget and salary ordinance adopted in the previous year. Of course, written internal control procedures and evidence of those procedures has to be established to provide reasonable assurance that the financial compliance and reporting objectives for ARPA funds will be achieved. And our field examiners will look at those, of course, during an audit like they would for any other transactions. And then just make sure that the procedures outlined in all of the state examiner directives and related memorandums are followed. So I just wanted you to know the general information contained in that directive. You can find that on our website and read more about it there. And finally, on this last slide, before I turn it over to Todd, we have our contact information as always. But I know I speak for both of us when we say we've enjoyed working with you in 2021. We've enjoyed getting to interact with you at these monthly meetings, and thankfully we've had some in-person events as well. And we wanted to wish you all a Merry Christmas and a Happy New Year.